Welcome everyone. My name is Ian Dembinski from Rathbones, and it's my pleasure to be hosting today's 30-minute second quarter investment insights program. There may be Wimbledon on BBC Two later today, but we have our own excitement in the studio as I'm joined as ever by two of our finest and best, Ed Smith, who is Co-Chief Investment Officer of Rathbones, and Oliver Jones, who is Head of Asset Allocation. What a treat! The second quarter headlines have been dominated by politics. In Europe, we've seen a generalized lurch to the right, with Le Pen's party leading the polls in the French election, and in Holland, where far-right Wilders has made big gains on the political stage. Meanwhile, in Hungary, Orban is in a constant state of tension with Brussels over Ukraine, whilst channeling his inner Trump with his EU presidency slogan, "Let's make Europe great again." No, you really couldn't make this stuff up. Meanwhile, last week's US presidential debate saw, how shall I put it, a less than coherent performance by President Biden, which was so halting that many in the Democratic Party calling for him to stand down for a younger nominee. I do hope that Ed and Ollie, that the three of us don't get an attack of the Bidens and that we can retain some semblance of coherence. And here at home, Rishi Sunak launched his election bid in the pouring rain, which prompted some wags in the press to opine that things can only get wetter. The UK election seems to be heading for a Labour victory if the polls can be believed. However, the polls have been known to get things wrong. And if that doesn't happen, well, we'll be bucking the global trend of a move leftwards, albeit rather centrist left. So I'll be asking Ed to update us on markets since we were last on air, and giving us some insights from the first presidential debate and the likely impact of the UK election on markets. I will turn to Oliver to give us some more insights into the UK market, in particular to reveal that there are still some opportunities to unearth here at home for a market that has come in for some negativity of late. So before we begin, please do write in your questions in the chat function, and I'll pick these up as we go along on my trusty iPad. We're also very interested in your views on whether you like this format and approach, so please do also write some feedback so that we can continue to improve how we communicate with our community. Now, with no further ado, let me turn to Ed, and can you start by describing how markets have evolved since we were last here at our last quarterly webinar?
Sure. Well, let's turn it right back actually to the start of the year, the first quarter, January to March. We saw stock price gains broadening out beyond that very narrow list of winners that dominated last year's market. But profit expectations, profit growth was still relatively hard to come by. In fact, most companies' earnings were being downgraded. Now, in the second quarter, more recently, that's flipped on its head. Earnings breadth, earnings momentum has broadened out. In fact, earnings breadth, by which I mean the number of US companies seeing earnings upgraded relative to those downgraded, reached a two-year high in June. But perhaps counterintuitively, stock price gains have actually narrowed right back down again, despite that earnings breadth, particularly in the final 6 weeks of the last quarter. Now, some of that might just be the fact that stock markets don't necessarily move in a straight line, and there was a period of tempering of expectations. For us, we are focusing on that earnings breadth because stronger earnings momentum and broader participation in that earnings momentum does tend to herald better price gains tomorrow.
So for much of the last 2 years, we've been worrying about two key things, haven't we, really? Inflation and growth. How have they evolved recently?
Yeah, so let's start with inflation. In the UK, we have been confident for some time of a downward path continuing, and we're still seeing that. In the US, we've been flagging some risks since the start of last year. Now, there's a really key component of US inflation that the Federal Reserve, the interest rate setters, have been telling us is really the only game in town, and that's core services inflation excluding housing. And let's bring up a chart behind me here to really illustrate this point. This shows core services ex-shelter, as the Americans call it. And you can see since the end of last year, that really ramped back up to really quite eye-watering levels. These bars represent the month-on-month change in that price series. But it's really pleasing that the last data point, which represents May, all the way over on that far side of that chart, shows that the prices price gains have not only slowed, they're actually now outright deflating. Now, one data point doesn't make a trend, of course, and the Federal Reserve will want to see a few more readings, a little like that final one on that chart. But we think that is quite likely, especially as wage growth, which is one of the key drivers of the service sector pricing environment, is continuing to slow, and various leading indicators of wage growth that we look at suggest that that is going to continue right the way towards the end of this year. Now, as for the growth element, there has been some signs lately that the US consumer is starting to feel the pinch from those past rises in interest rates, but we do not see the signs of weakness or the signs of excess that often precede a recession. And the US consumer is still in reasonable shape. You've seen some global economic data start to disappoint expectations, but disappointing expectations doesn't mean that it's outright weak and going to head towards a recession and a bear market. It just means that expectations perhaps got a little too over-optimistic, and there's a period of tempering. So we expect growth to slow a little this year, particularly in the US, come back a little in Europe, which had recessions last year. Overall, we think the environment is conducive to risk assets continuing to do well.
Now, we've had the first US presidential debate, and we saw Biden's rather incoherent performance. How does that leave us, do you think, in terms of the November election, how we should be positioning ourselves?
So we think it's too early to premise our portfolios on an outcome one way or the other. Before last week's debate, you saw Trump lead in 4 key battleground states, the Arizona, Georgia, Nevada, North Carolina, and have a narrow lead in 3 more on top of those 4 where he had large leads. We haven't got a decent set of polling numbers since that debate. I suspect it's judging by the betting markets, it's moved a bit more in Trump's favour, but we'll have to wait and see. And there is, of course, a significant margin of error in these polls. We don't think we're at the stage yet where we can say convincingly we think it's going to be one outcome or another. We might never get there. So the important point today is not to premise portfolios one way or the other, to maintain that diversified approach.
Now, there's a couple of questions coming in which are relevant to what you've just been covering. Perhaps I could take them now. There's one question: services presumably means what exactly? Lawyers, solicitors, for example? You mentioned ex-services.
Yeah, so that's great question. Yes, it does include professional services fees, like in insurance and the legal fees from buying and selling property, portfolio management fees.
Yes.
They're in there, as well as hairdressers. And things to do with
hair and
the
makeup we've
housing
had this
market.
morning.
Yes, I needed
Indeed.
it quite significantly.
Excellent. And just one other ancillary question: do you think interest rate cuts in the US will come in time to help Biden?
No, I mean, they may start before the presidential election, but of course the effects, feed through with a lag. There are parts of the market parts of the economy which react relatively quickly, but on average it takes 12 to 18 months and sometimes even longer for the full effect to come through into the economy. So that will be way too late for Biden.
Okay, so Ollie, turning to you, we've had a lot of questions about the UK stock market. We'll get to the election in more detail in a moment, but can you give us some context on how UK stocks have performed since we last met and how you're thinking about them?
Sure. So, we're just past the halfway mark of the year now. So far this year, the UK market has returned about 7%. That's pretty good going. In sterling terms, it's better than we've seen from Europe and Japan. So that's an improvement on last year. Of course, it's still some way behind what we've seen from the US market, but I mean, Ed mentioned this point earlier. In the US in particular, the market's been so narrow. It's been a few very large tech firms that have powered the US market. So if you compare the UK to the average US firm rather than the whole market, in fact, the UK's done slightly better. Take that comparison all the way back to 2022. And the gap's really quite big. Actually, the UK market's done about 10% better than the average US firm since 2022. I think that really surprises people. The UK market's been much maligned in that time. I've seen articles in the financial press that read like obituaries at times. So yeah, quite an incredible contrast between perception and reality at times. We've talked about the market as being one that we think has a low valuation, so we think its price is low compared to its fundamentals. And we're now seeing that translate into a positive catalyst because there's been a lot of interest in UK firms as acquisition targets, particularly from the US. I think it's been the strongest bid activity for UK firms since 2018. So that's been a real positive catalyst for the market.
But is that also rather worrying for the UK market that our best companies are being bid for, therefore narrowing even further the market capitalisation?
It depends on your perspective. I think we read stories about UK firms as acquisition targets. We read stories about UK firms considering shifting their listings to the US. But if you're a UK shareholder, well, it's a good thing for you because you're the one that gets the uplift. So I think, yeah, you have to not confuse the perspective of the shareholder and the market more generally.
So if the UK trades the discount, what will change that? What will make things narrow the gap?
So, well, we've mentioned one key thing already, which is that potential interest in undervalued UK firms as acquisition targets. Another, we've thought about the election a bit in this context as well. Our work has shown that discount associated with the UK really emerged after 2016, after the Brexit vote, and of course all the political instability that unleashed. So even mere stability could be a good thing from that point of view.
And to illustrate your point, we saw in France the French market trade off after Macron's snap election decision, with political uncertainty causing that French market to reverse as well.
Yeah, absolutely. And then thinking about politics in the UK more generally, there are another couple of areas that we would look at, areas where I think there's a political consensus actually across both of the main parties that the UK hasn't been doing enough to facilitate investment. The current government has sometimes struggled to find the political capital to push reform through, but potentially a new government with a stronger mandate might be able to. So one of those in particular is the pension system. Pension funds hold a really small amount of their portfolios in UK equities. A new government's likely to make some legal changes to try and encourage that, potentially create some new vehicles that encourage or make it easier for pension funds to invest in UK equities too.
Now, Ed, there is a UK-related question for you, because the question is that rates actually still look pretty high, 5.25%. Do you think the UK is going to hold back on cutting rates ahead of the US, or could you see a divergence with the UK going before the US?
I mean, you have seen that in the past. There's some people seem to think that the UK is always a follower and the US sort of sets the trend, but that's actually not the case, even relatively. Recently, you've seen divergence in monetary policy on the way up and the way down. The market, the interest rate futures market, which predicts UK interest rates, has about a 50-50 percentage chance that the first rate cut will come in August. Whether it's August or not, it's pretty likely to be August or September. Yeah, we're longer term investors, so it really doesn't make too much difference to us. The important point is that we do think that the first interest rate cut is more or less around the corner. And because of that, we are quite constructive on UK government bonds that we think is pricing for too shallow a cutting path ahead of us over the next couple of years.
And switching back to the US, if you don't mind, US rates could herald another rally in the stock market there if they start cutting?
It's possible, and particularly areas that are more sensitive to interest rates might respond relatively better. So smaller capitalisation stocks tend to do well when interest rates are cut. They have a much greater percentage of floating rate debt, for example. So when interest rates cut, the servicing of that debt responds immediately, and that feeds through to their bottom lines.
Okay. Ollie, now, you just published a piece, Investing for the Next Decade. So on the long-term outlook, where do equities, UK equities, sit in that investing for the long term?
Yeah, hopefully everyone who's dialing into this online can see that on the platform. It should be available to you. Just to give a bit of context about what the report is, every year my team conducts an exercise where we take a really granular look at the 10-year outlook for the global economy, growth, inflation, interest rates, and then what that means for all the different assets we invest in. It's built on a huge amount of quantitative work. Don't worry, that's not in the piece. It's hopefully very readable and focuses on the key narratives that clients will be interested in. On the UK specifically, it actually comes out quite well in that analysis. People are really used to the idea of US outperformance, the US stock market dominating. We take a look further back in history, the past 10, 15 years or so are not really representative. You know, you only have to go back to the 2000s for a period when the US wasn't the dominant market. The UK was doing much better in relative terms. Leadership changed over much more regularly before then as well. So that's a key focus and links back to what we were saying earlier about valuations as well and the potential tailwind there.
So we've been focusing more on the stock market, as touched on the bond market. Can I get the UK context for our bond market and how we could see things playing out? Because if there is more spending to support social services, you get a greater stock of debt, don't you? But on the other hand, we expect inflation to come back down, which is broadly supportive of the bond market. Where do you sit in terms of the outlook for the bond market?
So there's been a lot of discussion before the election about the idea that Labour, obviously currently leading in the polls, if it were to win the election, would inherit spending plans which don't look realistic. The Labour manifesto contains a pledge, no return to austerity, but the spending plans have big cuts to unprotected departments in them, so that's not likely to happen. Well, they've got two options: raise taxes. Now, they may raise some taxes, but they've ruled out changing the biggest ones: income tax, national insurance, VAT and corporation tax. We may see some changes on capital gains tax, inheritance tax, for example, but that's probably not enough to make all the difference. I think we're likely to see some exploitation of, you could say, the flexibility around the fiscal rules to allow the government to borrow a bit more, maybe some technical changes like how the debt held by the Bank of England is treated, for example. So there probably will be a bit more borrowing than is in current plans. The key question you asked it, will that worry the bond market? I think on balance, probably not. If that money's being borrowed to invest in the public services that sustain the economy, we're talking about things like the court system, like maintaining local roads, for example. I think the bond market's likely to take much more kindly to that than, say, Liz Truss-style tax cuts for the well-off, which, you know, don't make much difference ultimately to the growth outlook.
Okay, there's quite a lot of crystal ball gazing going on in the questions here, so I've got some tricky questions for you, but one's come in: have the UK financial markets already factored in a Labour victory? And do you think if that pans out, the markets will fall on Friday morning, or it's actually the markets really discounted that already?
I mean, so the polls have been indicating a very significant Labour victory right from the moment the election was announced. Yeah. And to have a swing away from that to a hung parliament would be, you know, the biggest error in the polls just a couple of weeks out before an election since modern polling began in the late 80s. So that would be quite extraordinary. And I think because of that, the market, you know, is expecting a Labour victory, probably a relatively large one. And insofar as markets are at least partially efficient, a lot of that is going to be in today's price. I think you'll see a relatively calm market on Friday.
Okay. Then there are wider questions about the macro risk, geopolitical risk coming in. Let's not forget the Ukraine war. Let's not forget that by the time we get to February, say, of next year, we could have definitely right-of-centre governments across the world creating perhaps more of an axis of support for Russia than they've got currently. How do you see the macro risk playing out?
Yeah, so geopolitical risk is always very hard to quantify, and it often sits in the tail of the likely outcome. So small probability, but potentially big impact. So the way that we deal with this at Rathbones is that every year we sit down once a year and we look at what we think are the most important geopolitical risks. We partner with a third party, an external firm who are geopolitical experts to help us monitor those risks. And what we try and do is give reassurance to our clients through preparation. We can't predict whether those events are going to happen, or indeed whether they're really a 10% probability or a 50% probability, but we can prepare for them. And our four key risks at the moment are an escalation of the war in Eastern Europe, either tactical nukes or another country, an all-out warfare between Iran and Israel, a systemic cybersecurity attack on par with nothing that the world has seen so far, and China invading Taiwan. Now, again, I don't want to alarm people.
To cheer us up.
I don't want to alarm people. As I say, these sit in the tail of the distribution, but they keep everyone awake at night. We know that because we make our clients tell us that, right? So what we do is we prepare for those. We assess the economic outcomes and the investment outcomes right the way down to the sector level, so that if God forbid one of these things happen, we have something to take off the shelf that we can implement in our portfolios pretty quickly, and that should put us in a better position than a lot of our peers.
And there's some speculation here amongst the questions whether tax policies could possibly lead to a further outflow of wealth in the UK. So, for example, it's the Conservative government that's actually changed the resident non-domiciled policies and tax base. Do you think a flow out of wealth could lower and affect the markets in the UK?
So I think there is a risk of some outflow of personal wealth. Now, a lot of that wealth is not actually invested in the UK market. So I actually am less convinced that it would make a huge difference. And as Oliver highlighted, the UK market is already priced for some pretty dire outcomes, right? It's been so beaten up since 2016. I think a lot of people are concerned about capital gains tax and what that would do. But again, the vast majority of the UK market is owned by overseas investors who don't pay capital gains tax in the UK. Another large chunk is owned by institutional investors in structures that aren't subject to CGT. And another chunk is held by people like us in ISAs and SIPs. And again, that's not subject to CGT. So we actually don't think that changes in CGT will necessarily cause this big fall in the market because people are having to or trying to sell out preemptively in the way that some people in the press have been speculating.
And Ollie, do you see any more difficult to find opportunities in the FTSE 250 as opposed to the main board? Are there interesting undervalued companies in there?
Yeah, absolutely. I think there's in fact a global trend really that there's a lot of value in smaller companies. This is something we've been looking at really closely this year. Yeah. All around the world, including in the UK, we see the valuation gaps between big and small companies about the biggest in 25 years, in a quarter of a century. So it's an area that we're looking at very closely. And we've started to see performance in that area in absolute terms improve a bit, generally still not quite keeping up with the larger stocks, but this is something we think about as a long-term investment. Whenever the argument's about valuation, we're thinking about the long term. So yeah, definitely an interesting area.
And Ed, moving more internationally, foreign equities, we saw Japan march forward very strongly. Are there any areas that you still quite like the look of?
I mean, Japan is still one of our highest conviction trades. Yes, there's been a tempering of performance lately as people digest the likely outcome of the yen going forward and other things related to monetary policy. But actually, we think that there are key structural drivers in Japan that will cause that return on equity to continue to catch up to the global return on equity that has powered a lot of the gains in Japanese markets over the last 10 years. Yeah, we spoke about the US. Whilst the relative attraction of the UK has increased, and Oliver set out why you might see a period of UK markets at least keeping pace with global equity markets, if not outperforming them. That still doesn't mean that actually we are not global investors making the most of a global opportunity set, and opportunity abounds in the US markets. It's just a matter of making sure that you're paying the right price, looking at the valuation metrics that matter in today's world, with things with returns fueled by intangible capital, software code and branding and all of that. So we look at free cash flow yields, and even amongst some of those quite dazzling companies that have done very well, there are still opportunities in the US that we like very much.
Now, there's a question about active versus passive, because last year, if you were passively invested, for example, in global markets and the US 7, Magnificent 7, you would have done very well. Now, actually, those 7 have detached, more like 4 and 3. Yeah. And actually, a passive approach wouldn't have helped you quite so much. Where do you sit in that debate between active and passive?
Yeah, so I mean, as you set out, like, a passive approach means that you are buying yesterday's winners by definition, because most stock markets are market cap weighted. The companies that are biggest have the highest weight. Now, some of the yesterday's winners will continue to be tomorrow's winners. Yeah. One of the most powerful forces in investing is momentum, for a bunch of reasons that behavioral economists can tell us more about. We won't go into today. But we know that as a group, as indomitable as the top 10 stocks in an index look at any point in time, as a group, they tend to underperform over 3 years and 5 years and 10 years. The average underperformance of the top 10 stocks at any point in time over the last 30 years, 5 years ahead, is 17%. That's quite remarkable. And 4 or 5 of those companies in the top 10 fall out of the top 10 over the following 3 years. And passive exposure is just giving you quite a large weighting, particularly these days in more concentrated markets, to these stocks, some of which will almost certainly underperform. So theoretically, when you have this increase in concentration, given what we know about how these companies tend to perform, even though they look, as I said, indomitable at the time, it actually presents a greater opportunity for active investing. But you will need to make sure that you have good percentage weights in those large companies that are going to continue to do well.
And very quickly, I think we've just got a minute left. Will a change in government encourage investment in newer technology companies? Can you see that being a big driver for whoever's in number 10?
I mean, I hope so. The UK actually has a brilliantly dynamic startup culture in technology, and a lot of our flows into UK investments come into the technology sector. It just doesn't translate into the stock market because the number of listed companies is very small. So we do want the UK government to really embrace that sector, which in the unlisted sector is doing really well. Create the environment that fosters more and more investment, and try and bring some of that into the space that Rathbones deals in.
Excellent. Well, sadly, we've run out of questions, and there's a whole raft of fantastic questions here. I wish we could take them all, but unless we can't. So our next webinar is on the 8th of October, and please also leave any comments on any areas of improvement for these sessions and the content that we cover. We'd love to hear from you. And finally, on this Friday, we'll be publishing a special edition of our quarterly insights covering the election results. Do look out for that on our website. Wishing you a great afternoon. Hope you also watch Wimbledon, and happy voting this week. Thank you very much.